This video is about managing financial accounting statements. Financial accounting is the process of recording, summarizing, and analyzing an organization's financial transaction in order to show its financial performance and financial status, either at a specific time or over a period of time. There are three different types of financial accounting reports. These are known as financial statements. There is the balance sheet, the profit and loss statement or P&L, and the cash flow statement. A balance sheet is a picture of what is owned and what is owed at a point in time. Each fiscal year starts with an opening balance sheet. In this case, the fiscal year starts on January 1st. The closing balance sheet shows the end of the fiscal year. In this case, that will be as of December 31st. Both balance sheets have the same format but will show different numbers. A balance sheet shows an organization's assets, liabilities, and equity. As the name suggests, a balance sheet must balance. Assets must equal liabilities and equity. Assets are what we own. There are different types of assets. Cash includes cash at the health facility and any money in a bank account. Receivables are money owed to the health facility by clients or others. Inventory at the health facility is considered an asset. It can include anything that is used to provide medical services such as medications as well as consumables like medical supplies and nutritional supplements, etc. Fixed assets are those items that a health facility owns and utilizes to provide services. These may include equipment, furniture, and vehicles. Liabilities are listed on the other side of the balance sheet. Liabilities are what we owe to others. There are different types of liabilities. Payables are unpaid bills. Accrued liabilities are monies collected by the health facility that are owed to other agencies such as payroll taxes for employees. Debt is a contractual obligation for borrowed money that must be paid over time. Equity represents funds or grants that are received for specific health programming. For example, if a donor gives funds specifically for the purchase of medicines, then those funds must only be used for that purpose. The total value of the assets should match the liabilities and equity. As you have learned, a balance sheet is a picture of what we own and what we owe at a point in time. There are two other kinds of financial statements you will need to know: a profit and loss statement and a cash flow statement. These are used to describe what happened during an operating period, which can be for an entire year, a single quarter, or even a single month, whatever is needed. A profit and loss statement, or P&L, is also known as an income statement. This shows how much revenue or profit an organization has acquired during a period of time. Even a non-profit organization can generate revenue or profit. The difference is that a non-profit organization does not share revenue with stakeholders or owners of the organization. Instead, any profit generated is typically invested back into the organization to support operations and programming. Income statements include information on income and expenses. There are different types of income. Operating revenue is the general term for income that an organization has to support the operations of an organization. It can generally be seen in two buckets: unrestricted revenue, such as cash that is generated from sales or services or donated, but is not required to be spent on a specific program or effort. Restricted revenue is income raised that must be spent on a specific program, effort, or department. Therefore, it is restricted in its use. Using the previous example, if a donor gives you a grant for medicines, this money is considered restricted because the donor has specified the money be used for a certain purpose. The health facility is not allowed to spend the money to buy a vehicle, as that is not the purpose of the funds. There are also different types of expenses. Most organizations will have standard expenses such as rents, utilities, supplies, salaries, travels, etc. There may be other expenses that are specific to your health facility, such as a project or program expenses like training, job aids, medications, etc. Expenses can be listed in categories on an income statement, but are generally listed in more details on a cash flow statement or budget. A cash flow statement shows the sources and uses of cash during a period. The cash flow statement also shows the sources of funds and the use of those funds over a specific period of time. It is a projection of cash flowing in and out of the organization, but it can also show actual cash collected and utilized. For example, before your fiscal year, as part of planning, you may develop a budget of expenses and a cash flow projection for the year. This cash flow will show revenue that is anticipated, how much, when, and from who. It will also show estimated expenses over time. As the year progresses, monthly projections can be changed to reflect actual numbers. When you close the books at the end of the fiscal year, the cash flow statement shows you the details of how you got from the opening cash balance to the ending cash balance. Cash is generated from operating activities, investing activities, and financing activities. Income statements and cash flow statements help to explain the movement of cash, especially during the time between balance sheets. Financial statements are valuable tools that describe the performance of an organization. They help managers understand the financial health of the organization, help managers make financial decisions, guide planning and forecasting, and provide internal accountability. Outside the organization, financial statements demonstrate the organization's financial standing to investors, donors, partners, stakeholders, lenders, and creditors. Financial statements determine if an organization is using funds as intended, demonstrate if the organization is following funding requirements, show accountability and financial transparency, and allows external parties or regulators a way to audit an organization. Every organization, including health facilities, should have financial statements. These documents will help monitor operations, demonstrate financial accountability, and allow managers to ensure operations are effective and sustainable.